And welcome to August 31st, 2020. I'm Andrew Horowitz, and this is the H&C, or the Horowitz Company, pop-up Q&A webinar where you get the opportunity to ask any questions that you want with relation to the markets or what's going on with the economy or finance or anything in between. Please do me a favor and ask all your questions in the Q&A panel, so we'll get to those in the order that they are received to make sure that nobody is left stranded out there. They didn't get their questions answered, or at least the best of our ability. Of course, we have to do our disclaimer here and mention that this is for educational purposes only. It is not a recommendation to buy or sell any security. Past performance is no indication of future results. Of course, because investing involves a significant amount of risk where you can risk all or part of your capital. So again, this is for educational purposes only. So what we do in this is we try to spend a little time in the beginning of the discussion talking about kind of some of the things that are going on and what's happened in the last week, what we're looking forward to in the next week, just to get a basic idea and an outline of what it is that is happening, what is driving the sentiment for stocks, what is driving the markets, what may be good that we're seeing in the future, and maybe some of the potholes that we have to look out for. So here we are. It is the 31st of August, and already we have seen one of the best since, I think it's 1984. I believe it's 1984. Now, you're probably hearing a little bit of thunder out there. We have a wicked storm happening, so hopefully we're not going to have a power outage with this. But it is the best August since 1984 for both the Dow and the S&P. Actually, it was such a great month. We saw that the S&P was up 7% for the month. The NASDAQ was up almost 11% for the month. Small caps were up 4%. And pretty much, except for the Dow, we have all-time highs on the S&P 500. We have all-time highs on the NASDAQ. The small caps have a long way to go to get back to that level. And some of the non-U.S. markets in Europe and other areas also have some ways to go here. But, the question that a lot of people continue to ask is, what's going on? Now that most indices have gone up as much as they have, and they're positive now year to date after taking that massive fall in March and then starting to recover at the end of March through April and then gaining momentum and traction. And we had talked about the fact that, hey, you know what? We want to make sure this is not a fake out. We talked about this probably in April or May, looked at the investor psychology chart. We looked at where things were and where there was the potential for this to be something that wouldn't be long lasting. And to our surprise and to our pleasure, and it's good news, things really did play out in an incredible way, because we did get the stimulus, not only from the Fed, but we also got the fiscal, or the federal government, chipping in trillions of dollars. And around the world, I think the tally is somewhere near $12 trillion was pumped into financial systems and credit markets, and in some cases stocks or ETFs on the open market. So this really helped to put a fine point on, what? The Fed, the government has our backs, providing a green light for people to invest, and in some degree, possibly inflating bubbles in certain areas around the markets, whether it be the NASDAQ, the technology names, or biotechs, because a lot of interest in those areas, of course, due to COVID. But what we're seeing right now is that essentially nothing fails. Kind of a replay of, to a degree, what happened back in the financial crisis, where the government stepped in and saved all the banks and all the financial institutions. This was even more so, because in this circumstance, what we saw happen was that the Fed came in and didn't just do quantitative easing. It didn't just do a low interest rate, but what they did was they not even by in theory, they actually went in and bought bonds of companies backing the credit markets that were frozen up due to the fact that there was no spending during the lockdowns, or very little, and people were very fearful. They were pulling back. And there was a problem where companies couldn't issue debt that they needed in that kind of circumstance. And under a normal market condition, that is what happens. We see that there is a moment in time when you have a problem issuing debt. And probably that moment in time is right to have problems, because who wants to buy debt in companies that you fear may not be there to pay it off in the future? But what the Fed did was say, you know what, we're coming in here and we're going to buy. We're going to directly buy ETFs. And then they even came out and said we're going to directly buy certain bonds in the markets. And that was significant. So what happened there was that moment created a relaxation in the credit markets. And what we saw was this incredible move of liquidity that came into the markets. Credit markets unfroze. They were only frozen up for a little while there. And they unfroze, thereby making the sentiment for investors much more comfortable, feeling that they can now not worry about the implications of a shutdown, of a gross domestic product down 31% for the quarter, worrying about how long the recession would last, and allowed for them then to feel that these companies are going to continue on. Now, we also know that about 70% of the small cap universe is currently not profitable. We know that there are significant problems in many different sectors and regions, but the fact that the Fed had come in and done this, it freed up the credit, which is what companies thrive on, right? Issuing cheap credit, cheap. You know, we got a zero interest rate policy, ZIRP, or called ZIRP. This is zero interest rate policy, basically bringing down the cost of credit, overall. Why do you think there's people that are rushing out to buy RVs, cheap, boats at cheap rates, cars, all sorts, going out to buy houses in a time when there's a lot of concern and confusion, where a lot of people are saying, wait a minute, I'm still not going to be spending a lot. I'm still not really going out. I don't know how long this thing is going to last. And therefore, what's happened is the low rates provided cheap credit. It provided liquidity to the markets. It unfroze the credit markets, and everything started, the machine, if you will, started to once again turn. So the Fed has even pushed even harder last week. Not only are we at a zero interest rate policy, not only are we on a continuation of the quantitative easing, buying bonds in the open market, buying ETFs, but what they said last week was unbelievable, actually. Because we know historically what we've seen in Japan and what we've seen in Europe with negative interest rates did absolutely nothing to create this inflation at this 2% rate that they wanted. The problem was that really the Fed doesn't have the ability to do that in a world that is relying so much on the gig economy and on technology. And those are generally deflationary powers that push through the markets. And the amount of deflation that's happening, in addition to that's normal, what's going on, just because of the progression and the continuing expansion of technology use, et cetera, that level of deflation was then accentuated by the turndown that we saw. Now, the Fed couldn't get ahead of this 2% rate for a very long time, and neither could Europe or Japan or most of the world. But what they did last week was said, you know what, pretty much we realize, I'm paraphrasing, and I'm kind of giving you the summation of what was the read between the lines version of what Powell said during his recent speech at the Jackson Hole virtual confab. And he said, you know what, we are going away from a 2% inflation targeting. Whereas that's what they were looking to do. And if in fact we saw that employment rates were good and inflation was starting to pick up, they would start to slow down the economy by normalizing rates. In other words, raising rates. What they said was, you know, what we're going to do now is really not worry about that so much. We're not going to worry about inflation. We're going to work on inflation averaging moving forward. And what does that mean? Inflation averaging essentially means that we're going to take what the past year or two, let's say, and what the inflation rate was, and we're going to add it to where we are now. And if we're still under 2% at that point, we're really not going to do anything. Very interesting. What that is, without going through all the entanglement of what that actually, how it works, is this. They are committing, recommitting, confirming, reconfirming that they are not going to raise interest rates for a very, very long time. even if inflation starts to peak and pick up at 2.5%, 3%, maybe even 4%, it's going to take a long time to get that average back, depending on how far back they look. And what that's also telling us is something else. Another point of reading between the lines is this. They know inflation is coming. It's starting to show up in the monthly CPI numbers. It's starting to show up in the PPI numbers. As the dollar is moving lower, it's starting to also have an impact on the cost of goods. And that being the case, they want to make sure they are way ahead of the curve here in order to make sure that people know that they're going to keep interest rates down, even if we see a spike in inflation. So what that tells me is inflation is coming. And that's why we've seen things like the commodity space, gold and oil and platinum and silver move up significantly. So they're telling us that there is inflation coming. They're also saying, hey, don't worry about it. We're not really going to adjust any of the numbers right now. We're not going to be worried about the 2% number, even if we see inflation. So don't start freaking out that we're going to start to slow down the economy, because we also have a 10.1% unemployment rate, possibly going up in the next week or so after some of the numbers we saw. So therefore, markets were, again, put at ease. So when we look at what the Fed's job is, it really isn't supposed to be the markets, but price stability is a big part of what they talk about. And when they talk about price stability, they're really talking about the markets. They're talking about the credit markets. They're talking about the stock markets. So this inflation averaging that they're going to be doing, again, clearly means that regardless of how good things get, even if we get a vaccine and things go back to normal, until we see a significant move above 2% on an average basis looking back sometime. And their second point that he mentioned at his recent speech was they're trying to target the lower paid and lower wage base employees and try to focus in on their tools that they have in order to provide for them, because those are the people who lost the most during all of this. A lot of layoffs, obviously, of the lower income strata of the range, and they really want to focus on that. I have no idea how they can do that with just a simple interest rate policy or quantitative easing. Makes no sense to me. The only thing they could do is juice the economy so much that it becomes so profitable for companies that they just say, you know what, we're going to be hiring people back. However, here is the rub. The problem is that many of the jobs that were there have been replaced and have been actively replaced by, well, some technology. I have heard story after story from various people in different lines of business how a veterinarian, for example, no longer, because of what's happened here, decided no longer do they need these employees to be the receptionist, to be someone who does the insurance claims. They went out and spent a chunk of money to reformat their office for digital filing, digital systems, digital claims filing, whether it's a veterinarian or a dentist, let's say, or even a plastic surgeon. A lot of doctors' offices are cutting back on staff, as an example. You look at other areas that maybe they're going to be using technology and leveraging through things like a Salesforce or some other kind of cloud-based system like Zoom, which just came out with earnings tonight and blew past estimates dramatically. You look at these kind of things that are going to be displacing certain workers in the field, and you have to realize that now we have a structural issue, because what has happened is something that's been going on for years but has been compressed into a 6-month period, and people saying, you know what, if we can work with fewer employees, we can have higher profitability. And that being the case, again, I'm talking about smaller businesses, not so much the bigger businesses per se, but even Salesforce, after they had a record quarter, laid off over 1,000 people. And we're seeing the airlines, because they're being forced to lay off people, small businesses. Now, can the baker lay off their best bakers? Probably not. But can they come up with a better accounting system and a better ordering system? Same thing with restaurants. Well, yes. And that is going to possibly be a significant issue coming forward. And while their goal will be, the Fed, just to bring this back, the Fed to do a significant job at holding this inflation averaging and making sure that we're not worried about inflation, but more so their employment mandate. It's very unclear how they're going to get there, which once again tells you that they're probably not coming off super low rates for a very, very long time. So one of the things we saw was this combination of the Fed and the fiscal, both here and internationally, and stocks, to a degree, defying gravity, because it's really exciting people in a variety of areas that stocks can do so well, and a lot of people are getting in on the action. Again, I've had a lot of opportunity to speak to people, and I cannot tell you the last time I recall having these conversations about somebody saying, hey, what do you think about that stock? I recently traded on my phone, and through whatever broker there. I'm like, whoa. This is a person, last night I had this discussion, who is 25 or 30, I guess he was 30 years old, thereabouts, and he's not working, but he's trading stocks. Now, whether or not that's going to end for him good or bad or however, I'm not sure. But you know what? He has to live at home now because he can't afford an apartment, not working, and now he's trading stocks. And one of the things that we are seeing is that many of the apps out there are making trading and investing look more like a game than it is actually investing. And that's bringing a lot of young people into the fold with the easy opportunity just to buy and sell things that may be worthless or not even something that's going to do well in the future. So these apps are really creating an excitement for the markets and possibly, again, reaching levels of bubbles in certain particular stocks or sectors. But this is something that we've seen before. We'll see how this works if people go back to work and don't have as much time to trade, as they're doing. Somebody looks over their shoulder. The boss says, hey, I waited for that paper that you were supposed to finish up for me, or that proposal. And what are you doing? Oh, I'm nothing. I'm just checking my text messages, as they're trading a stock. Or in a conference where they're back together, and maybe even a Zoom conference under the desk, trading stocks as they're trying to focus in on a meeting. So productivity could be an issue here in the future. Just kind of thinking about that as a potential. We are starting to see some very slight inklings and just the edges of I would call it potential rotation into post-pandemic plays. These rotations that we've seen so far over the last several months have been fleeting. We see the airlines pop up and then they just come right back down. We see the cruise ships start to move and the hotels start to pick up, and some of the restaurants and maybe even the movie theaters and maybe some of the gambling venues, they pick up and then they come back down. So we are starting to see this rotation. It's starting to pick up. It's starting to get more frequent. But again, most of the time what ends up happening is we see the move, and then a couple days later it reverses. A couple more things on my list here before we get to the questions. I'll mention any question that you have at all. I may not be able to answer it, but put it into the Q&A. It's great for all of us to learn from this. Your question, you may think, I'm not so sure I want to ask this. It could be really helpful for somebody else. And we have a lot of people that are with us today. So put the question in there, something that you've been thinking about, kind of been gnawing at you, something you want to know about, a particular area in the world of investing or finance or taxes or whatever it may be. A couple other things I just want to touch on here. The stimulus package that's currently pending, it goes back and forth. We have a $500 billion price tag that's being posed by the Republicans in the Senate. We have a $3 trillion deal of the Democrats in the House. The White House is somewhere in between all this. There's now starting to talk about the idea of a skinny deal, some kind of skinny deal where there's going to be a much smaller amount right now with things that are agreeable by both parties that could possibly get passed through the normal channels rather than an executive order. But, maybe it's just me. But $500 billion, even if it is at that lower end, the level that JP Morgan said would be a major problem for the economy and for the markets, is still $500 billion. That's not so skinny. And anybody who thinks that $500 billion is a skinny deal really needs to rethink about their numbers and the zeros and the commas. I mean, $3 trillion seems a little excessive at this point. Yes, there are a lot of people that are unemployed. There's a lot of businesses that are having problems. But still, we did recently put that amount, $3.2 trillion, into action. And that takes a while to really funnel through the economy. And so far, we put back, I think, 6 or 7 million jobs that were put out. And that was not necessarily because of the stimulus, but more so due to the path of the virus. And it seems that another $3 trillion, there's probably going to be a lot of pork and problems in that. Already we saw a lot of players and companies making out like bandits on the last go-round on what we saw. So I think there needs to be a smaller number, in my opinion, that's very focused on the things that are really out there that are specific to what's going on with the, primarily due to the impact of the virus and what that has had on employment, on certain companies, et cetera. Starting to throw in things like solar energy credits or possibly, some other kinds of things in there doesn't make a lot of sense to me right now. I think we should have some of this, the discussion about, of course, the employment situation, of course, the companies, and testing, and making sure contact tracing, because we don't want to start getting into this all over again in a few months. We've recently seen, just in the last few days, a new spike in cases in Europe that thought they were kind of out of the woods. We're starting to see that in Hong Kong and in China. They're starting to see another ripple of uptake in cases. And of course, we've seen from things like Sturgis and some of the other events that happened with people that weren't kind enough to their fellow people around the world to wear masks, who felt it was more important to make a statement about who they are rather than making sure that they would just do a very simplistic thing like wear a mask, stay away from other people through social distancing. No, couldn't do that. So now these 250,000 people that went to Sturgis came back and started spreading the virus throughout their various cities and counties and places that they live. Very sad situation. On the economics front, right now the data doesn't really matter, as we call it. We have some signs of slowing once again in the economy. And you got to question, is that slowing actually going to be good for markets or bad? So right now the idea is this. It's a very simple exercise that you could think through. Right now, the worse the data, the more we think that the Fed is going to step in to do something, the more that we think that the potential for Congress to get off their keisters to actually get something done. It takes kind of an emergency for Congress to do anything these days, especially to come together in any respect, right? So until the markets have a major event and there's a lot more pain out there, I think Congress is just going to slow play this whole thing for a lot of different reasons, political and non-political reasons. But we do see some signs of slowing, which could be actually good in a way, at least as perverse as this may seem, for markets, as it will bring the Fed in even further. Signs of good reports and economics that are better than expected could also be good, because then we have, hey, you know what? Things are getting better. And if things get better, we also know that probably the Fed's not going to do anything to unseat this recovery for some time. So it is getting better. It confirms that side of the equation of, hey, you know what? The economy is healing. Now, this Friday coming up, we have the employment numbers. So right now we have a 10.1% unemployment rate. Last month, there was a seasonal adjustment. I think it was a 700,000 plus put into the mix. I wouldn't be surprised if we don't have any seasonality adjustments this month, if we wouldn't see that actually we tick a little bit higher in the unemployment, as we saw the last couple of weeks of the initial claims, over 1 million again for first-time claims on a weekly basis, both weeks, 2 weeks in a row. And the fact that, once all the PPP money ran out, once all the money started to slow down, and we started to see that some places reversed and did not go forward with further openings, that we could see some issues in the in the employment issue. So it could set up for a slight higher number. What is that number? 10.4%, possibly backing up a little bit with instead of a very significant positive number, possibly a negative number. We'll see how this plays out. But, again, considering the seasonality of last month, it really wasn't that great of a number, but everybody seemed to, cheer on the fact that we just saw a number, not really digging down into the material information, which is fine. And again, as I said, right now, the data doesn't matter at this point. It will eventually. It always does. We go through these cycles, where earnings don't matter as much because we think it's better in the future, and economics, not such a worry because it will be better in the future. And all that, again, is rooted in what we've seen over the last, I would say, dozen years, with every single time there's a bit of a hiccup in the markets, a bit of a hiccup in the economy, the Fed comes to the rescue, kind of the knight in shining armor for all of us. But this time, like I said, it was more than the Fed. It was also the incredible amount of money that was put in from the fiscal, which I think was really important. So, all right, with that, let's load up the questions. Let me take a look at what's going on. Please put your questions in the Q&A. We'll get through there, and we will start answering those in a second as we see those build up. All right. First question. Oh, this is long. Or comment. Let's see what it says. Comes in from Andrew. He says, "Hi, Andrew. This is a question in regards to what you would do with non-essential savings, example, down payment towards a house, in light of the Fed's recent policy shift towards average inflation targeting. As an alternative to holding said savings in cash, I've considered employing a strategy that's made up of short-term immediate bonds, some tips, and a small percentage in a broad index ETF. Would you have any suggestions in light of the Fed's recent announcements in conjunction with current valuations and the state of the bond market? I've even considered a conservative investology portfolio, barring the suggestion of holding such funds in cash." So that's a loaded question, Andrew, because from putting on my financial planner hat, if you will, for a second, I'm going to put that on and tell you that short-term non-essential savings, which you are going to be looking to use in, when I say short-term, that is targeted, right? Short-term targeted money. Let's say, I'm just going to pick a number. It's $50,000, and you're saving it aside because you want to put it down on a house and you want to use some of that to then buy furniture and maybe fix it up and whatever you're going to do with it. The problem is that if you're looking at a 1 to 2 year period and you're thinking, I want to make some money on that because right now I'm not making a lot of money on it. Short-term emergency fund cash is not really, from all intents and purposes, supposed to be made money on. You're supposed to have it locked in a position that when you need it, if you find a particular house that you have, that you want, that you can go get it. Now, here's the problem. Let's say that you decide to invest it. Okay, and things go along swimmingly. You got a couple months, things are going well, and now all of a sudden the market takes a dip and you're down a few $1,000s or something of that nature, and you decide, you know what, I just found the house of my dreams and I want to buy it. Now I got to sell my assets, and boy, I don't want to sell them right now. And that's a real problem, because you don't want to get into a situation where you're going to have to worry about the valuation of your stocks to that whole process of buying a house. Now, if you have enough long enough lead time, if you have a 5-year period where you're not potentially going to do anything with it, okay, I could see that, maybe do something with that money. That's reasonable. But if you're a year or maybe even 2 out, I'd be really careful, because especially with markets towards a very stretched valuation point, possibly going higher, I don't disagree with that. But you know what? The likelihood right now is that the trend is higher, but the risk is lower because of valuation. So you want to think about, how you want to do that, and question even bonds that are at some of the lowest levels in terms of rates or highest value in terms of price right now. If you want to maybe split that up a little bit and say, well, as we call it, the 1 foot in, 1 foot out concept, right? If you want to split it up a little bit, that may be something you could do, but I think you really need to be broad-based and really well diversified, and probably very conservative in what you're doing, just so that you don't have a problem getting out, or at least having the opportunity to be liquid as fast as possible. So just a little bit of comment to look at, I think, first of all, what is your time? How long is this money really, and reasonably, be reasonable that you're going to really want to use it? What's that target date that you're going to want to probably take it out, and then make your decision based on that? Question coming in, what are the best ways to diversify to get out in front of probable inflation other than commodities? Well, if we have inflation traditionally, you would say, like, possibly go long dollars, and you go short bonds. The thought would be that if we have inflation under normal circumstance, that the Fed would start to kick in, stocks wouldn't do well, they're going to raise rates, bonds would have a problem. On top of the bonds having a problem, you may see that the dollar starts moving higher. So, then when the dollar starts moving higher, that's a problem for non-dollar denominated instruments, whether it's equity or debt, particularly those in outside of the United States. Your Latin America, China, anything that's denominated not in dollars or other currencies. So the problem here is that you're going to have inflation, but the probability of the Fed not picking up on it, or not purposefully picking up on it, right? They're not going to do anything about it. So, it would seem to me that commodities, I hate to say it, I'm sorry, but commodities are a great place to go. Alternative asset strategies, you can find them. We use those inside of Investology, and we also use them inside of the global allocations portfolio strategies. Basically, you have alternative assets that kind of are outside and non-correlated to markets. So beyond that, though, you obviously, if you're going to have a low interest rate environment for a very long time and inflation, the potential is that kind of takes off the dollar rising theory. I'm not really buying this, but in theory, it does. So external to the U.S. assets could be beneficial. You just have to watch the currency changes. The only thing you may want to do is try to find an alternative, like in emerging markets, which are heavily dependent on commodities and oil and all that, that are hedged out in dollars. That may be something you want to look at as well. Tips: Treasury inflation protected securities, which will move with inflation protected. It will move with inflation. That's probably a good one also. And we use those also in our global allocations, and we have a position in Investology in that as well. Next question. Hey, Andrew. Hey, Chris. I'm looking to smoke some meats for the first time ever. Oh, really? Seriously? Any tips, strategies, ideas for my first smoke? What type of meat would you recommend to first go? Thanks in advance. So, that's a good question. I'm going to answer this. Let's start with what you don't want to do the first time. You probably don't want to do a major brisket. It's really expensive. I would try and look this up. 3-2-1 ribs. If you follow the recipe, it's 3 hours at 175. Put some nice coating on it. 3 hours at 175. 2 hours wrapped in aluminum foil. You can put some butter and brown sugar on the bottom of that. Turn them down. Wrap them up. Put them back in at 200 degrees. And then take them out and let them then soak for another hour. Again, so look up 3-2-1 ribs. Look that up. That would be the best place to do it. And the big thing is what smoke you're going to use. You probably want to use something in the middle, something kind of, oaky, hickory. Mesquite's pretty intense. I don't know if I would use that unless you really want a hardcore barbecue smoke flavor. But a hickory's one. Jack Daniel's whiskey barrel's another one. You can mix them up a little bit too, like a pecan is nice for that. But get yourself a good smoker too. But try that. 3-2-1 ribs. Look that up. That's a really good. That's just a general guideline on how to make them. Good question. I like it. Ken asks, with people moving out of the big cities, what are your thoughts about the home builders? Yeah, I talked about this last week. I think last week or so on the Foodable Networks, the Barron Report. There's a video out there that I was on. We spoke about this for about 30 or 45 minutes. The home builders, listen, cheap rates are beneficial for home builders. Those home builders that are building a lot of single-family homes, not the high-rises, obviously, not the big buildings, maybe apartments could be okay, but it has to be kind of outside the city centers. I think look at them, most of them are close to all-time highs right now. A lot of that has to do with the low interest rate environment that we're in, and people looking to say, you know what, if I have to live in my house, at least I want a decent house to live in. You know, my daughter, for example, I remember a few years ago, she lived in an apartment in Manhattan, and when you opened up the window, you just saw a brick wall. You couldn't even tell what the weather was like outside. For that matter, you really didn't even know what time of day it was when you looked outside because all these other buildings surrounded it. So a lot of people are thinking about just moving out, and the home builders really are top notch. Great investment in the times of low interest rates. The problem is, you know, there's right now for them, there's not a lot of inventory in the market. That's good for them. And people are looking and buying sight unseen on a lot of places, especially the existing home market. So home builders can be very good. And I think the combination of low interest rates and the fact that people are moving away, just look for the ones that have a higher propensity to be building single family homes rather than multifamily. Next question comes from LB, we'll call him. I joined the Zoom late, so you may be covering this, but can you discuss Tesla? Is there anything underlying the move besides the split mania short squeeze? You know, it's those. It's those. The split, I calculated that the stock is up 65%, I think. I just did a rough, quick calculation of this. 65% since the split announcement, which is like 3 weeks ago. And right now, what's happening is that a lot of people think, you know what, the stock was not going to come down. It's going to go up forever, and I want in on it. And now that it's cheaper, man, it could probably get to those highs again. Of right now on a pre-split basis, it's like $2,500 a share. So it's split 5 for 1. It's trading right around $500 or so at the close of the market today. So yeah, you have a short squeeze that's going on, but should have been really squeezed out already. You got the potential people trying to short it, and then it's getting blown out and having to build it back up again. There's clearly a mania, and we have low interest rate environment. I mean, the fact of the matter is that Tesla, as a company, not making a lot of money. Does it deserve to be in the valued more than every other car company combined? Is it that now Elon Musk is the 4th richest person? He's more wealth than Zuckerberg right now from Facebook. I mean, something's a little bit out of whack on this whole deal. And yes, they have SpaceX in there, and they got the solar panel company going on there, and who knows what kind of bleeds into the other area when you're investing. If you're thinking that, hey, solar is going to be really good, which solar, by the way, has done very well recently. We have a few positions in the TDI managed growth strategy that have been unbelievable winners in the solar space. So maybe there's something going on there that they're getting a pickup there. But as a company, we saw their profitability just a few weeks back. It wasn't exciting. In fact, the stock was starting to roll over and roll down until they announced this split. All it's done is created a bit of a stir, an excitement about I can get Tesla cheaper now. So when it does it, I'm going to buy it. We'll see what happens a fefew days from now. Let's kind of let this all play out. But it seems to me that this is something that unless something remarkable happens, the competition that they have right now, which some of it's not great competition, but there's a lot more competition coming online, and their cars are not getting the best reviews. In fact, I think they're on the low end of Consumer Reports reviews these days. So from a number 1 position to all the way down to the bottom for their newer cars, the smaller cars is something. We have a couple more questions, but if you want to get them in, you could do so. Put it into the Q&A panel on your Zoom. Next question comes from Oscar. Hey, Andrew, thank you for all the information you provide and for doing these weekly Q&As. You're welcome. What is your opinion on SPACs that appear to be good opportunities, such as FMCI for Tattooed Chef, with its reported great growth, and LCA for Golden Nugget, which is profitable and is surging on the online gambling industry? So I think we answered this a couple times. SPAC is a special purpose acquisition company. Basically what they do is right now they're providing a really easy way to be absorbed into a publicly trading stock that really had nothing going on before that. Without going through the entire IPO process and the dog and pony shows and all the things that are involved in trying to raise capital to get the IPO off, they just get bought into there, they're funded, and they're put on the market. A little bit easier in some respects, but much more expensive in others. Because usually the SPAC has a manager on there that's actually going out and actively buying up another company. That manager has to be paid, 1%, 2%, 20% of the profits. So on top of the fact that you're involved in this SPAC, and it's not really a pure play, so that's negative. On the positive side, there's a lot of a lot of interest around these SPACs. I mean, you look at some of the electric car companies that went through a SPAC recently. One of them with the symbol SPAC, SPAQ. Nikola, I believe, was a SPAC. You have Virgin Galactic, which is Richard Branson's company. That's a SPAC. As you mentioned, a few of these other ones. I think there's a good opportunity. I think, again, once I start seeing these weird things happening in the markets, a Tesla that doesn't stop going down ever, even when it's down, it ends up the day up somehow miraculously, or it's just down marginally. But these SPACs are a sign of a little bit of a bubbly and frothy market condition. They're an interesting way and an easy way for companies to get listed and create some buzz around it. Now that everybody's talking about SPACs, which used to be called blind pools back in the day, that were always very aggressive and out there. And they've been out there for a long time. It's not really new. But what's happening now is it's getting a significant amount of interest, and therefore, people are bidding it up because people really don't understand what it is. They don't understand what they have, but they like what the internal company does. Whether they're profitable or not is another story. And if they were profitable enough, and if in fact they were able to, why not just go the either direct listing route or an IPO route, because they probably could have raised a lot more money. Just a point of reference. All right, Mike asks, I've noticed that most of my newly acquired bond ETFs are negative, and I thought they would be good when the equities go down. Do you use other options to or in addition to bond ETFs for support? You have to remember a couple of things. First of all, price on these are important to look at because both bonds and ETFs and mutual funds pay dividends. So you need to look at the price and then add back your dividends. And if you haven't done that, that may be something you need to look at. Number one. Number two, recently, when I would say within the last 2 weeks, bonds have been selling off. I mean, we saw a major move significantly down on yields, and the 10-year was trading an all-time historic low. And then as the economy started reopening a little bit, bonds started selling off. You look at like TLT, which is the 20-year bond. That's been selling off. So, what we use for support for portfolios, well, of course, you have to add back your dividends that you got paid on those, are things like, yes, we have commodities and we have real estate, which has done very well. We utilize things like alternative strategies, so, and non-U.S. So when you say for support, you said that you thought you'd be good when the equities go down, but equities really haven't gone down. They're just going up. So technically, if you think about it, bonds really shouldn't be doing much. I just looked at a few portfolios just earlier, and I noticed that for the month of August, we had just firecrackers, fireworks, and just, cannon booms when it came to the equities. But bonds were kind of sitting there, no loss, no gain, a little bit up, a little bit down, nothing major. I mean, you can't have every sector going up all the time. And the fact of the matter is that, bonds are also getting a little bit long in the tooth, just like equities. We had them both going up for some time, and you have to be careful of what your maturities and duration are and what your actual holdings are for the bonds, because if you're in the wrong duration, like long duration, and you see a spike, you can have an event there where you see a significant loss. Usually we try to stay right now in the shorter duration. We're very happy living in that world, getting a decent rate of return, but yet some of the volatility is not there. The other point is, obviously, as we go through this reopening, you have to look at your corporates and see that they've been supported by the Fed for a long time. How long is that going to really stay if the Fed starts pulling back and just kind of goes back to their normal process rather than supportive of ancillary areas like corporates? Next question from Rick. What do you thought about Berkshire Hathaway jumping into gold with the purchase of Barrick Gold shares while cutting back his bank investments? They still have fairly strong position in banks, it seems to me. So I don't know how much of this is hype. So Berkshire Hathaway, Warren Buffett's company, they bought a chunk of Bank of America, sold off a big chunk of Wells Fargo, finally, by the way. And I think they got rid of their entire position in Goldman Sachs they've held for years. The other thing that they did was buy gold. So what that's telling you is their thinking is that there is inflation ahead. Banks shouldn't fare well and don't fare well in an inflationary environment, right? Unless in a normal inflationary environment, they will. In a normal inflationary environment, the Fed is going to increase rates, thereby steepening the curve. Steepening the curve means that the short end of the curve is lower than the far end of the curve, like the 30-year bonds, compared to the one-year bond. And there's a steep curve, and that is really good for banks because they lend at they lend at the long rate, which gives them a higher income, and they take in at the short rate, which is paying out very little. Now, with that, in an environment like that, we have a very good situation for banks, right? If we have an inflationary environment where the Fed is actually stepping up rates. What they're telling you in the read-through from what they did is, hey, we're going to have inflation, but the Fed is not going to move rates. They're going to keep their foot down on the yield curve, thereby not making it profitable for banks. And if, in fact, we also have a double whammy where they're keeping rates down and there's a lot of defaults coming in, and we've seen loan loss provisions really spike up in the last couple of quarters of earnings reports from the banks. If we see that happening where they're losing money because people can't pay for their homes, they can't pay for the cars, the loans outstanding are defaulting, credit cards are being a problem. Therefore, we have a double whammy. One, they can't make money from their net interest margin, which is the money they make from the differential of the yield curve, the money in, money out. And secondly, they're losing money due to losses because the economy is in really bad shape. But if the economy is in bad shape, people and banks are losing money, et cetera, the Fed would usually adjust situation, but they can't. The Fed's stuck. They can't do anything. Therefore, what the read-through on this is that they like gold, something they haven't bought in years. They don't like bank, which they loved forever. And now they're going to believe that there is inflation coming without the Feds being able to do anything about it. Over the weekend, Warren Buffett also bought 5% in a variety of Japanese trading and investment firms, thinking that there's going to be a lot more trading that's going to happen, moving more money into financials, but yet not into the banking industry, looking at doing deals with companies that are going to benefit from the increase in trading phenomena that's going on right now. So it all stands to reason. If you think about that and you agree with that there's going to be inflation, the Fed is not going to shut it down, and they're going to keep interest rates low, the banks are bad, commodities are good. I think there's the last question. Last question from Doug. Why do company 401ks like my company use large brokers like Fidelity and limit my investments only to mutual funds? But I can't invest in ETFs. ETFs seem more flexible. What's up with that? Yeah, Doug, I'm with you on this. So one of the things you have with 401ks is there was always this fiduciary rule, and the whole relationship of the making sure to do no harm to people's savings. And in a way, they kind of constricted with an investment committee, let's say, to a specific set of funds that may let you choose from, let's say, I don't know, 10, 15, 20 different funds oftentimes, and they never really changed that. Now, some 401ks are a little bit more egregious in why they do it. They do it so that the 401k administrators can get a kickback, pay the fees so that the company doesn't have to actually pay any fees. But generally speaking, there were this selection that hit every category. Oftentimes they left out a few, but there's a lot of categories. And then, of course, the target date funds that were always in the 401ks. Lately, what's been happening is we've seen a lot more companies loosening up a bit and allowing for you to have a direct relationship with your broker if you take on that particular risk, if you will, where you can pretty much have a wide range of things that you can invest in at your own risk. And not all companies allow this. You have to talk to your HR and see if there's a way for you to open up a self-directed 401k, or if they have an option to have a linked account with your brokerage that allows for you to trade whatever you want to trade. But technically 401ks historically were not supposed to be for fast trading. I'm just telling you what the theory was. They're supposed to be long-term money, whether or not you have whatever percentage in bonds and cash and real estate and stocks and bonds, things like that. It didn't matter, but they pretty much tried to cover all their base with mutual funds. Not to mention the fact that, of course, it was self-serving. A lot of the 401k companies provided the custodial services and the administration, called third-party administration or TPA, and what they said is as long as you use our funds. So that's kind of where some of that came from. And many of the companies were just too lazy and didn't want to take on the risk, if you will. of changing things. Last thing they need is somebody trading their own account and then suing the company for allowing them to do that. That may sound ridiculous, but it happens. So I think that's one of the reasons why it's been that way for so long. And Ben, here we go. Ben has piped in a few things here. He says, with Fidelity, you can create a broker link, yep, and then you can buy ETFs. And he says also you need to specifically request this and sign up. That would also let you do some cash covered puts and cover calls for extra income. So yeah, there are ways to do this. Again, I think a lot of companies are very shy to do so. And it's not definitely that this is available. This has to be something your company elected. What you could do is find out more information. If you're at a company, let's say, that has 50 or 100 people, try to get the information, talk to your other employees about it, and then pressure your HR department and the board, the president of the company, to try to do something like this. Again, sometimes they don't like to do this because if you lose money, they're kind of at risk for allowing you to do that. It may sound ridiculous, but that's what the case is. All right, we're going to end it right there. A couple of things of note real quickly. We're going to have a great guest on the Disciplined Investor podcast this week, Paul Barron from Foodable. And we're going to talk about the restaurant industry, leisure, what's going on, some of the new things like ghost kitchens, and what's happening with the kind of the new next level leisure. This week we had a really good discussion on the Disciplined Investor that I talked about the elephant in the room. I did a little bit more of a wide discussion on the inflation targeting, inflation averaging. So something you may want to listen to. DH Unplugged is Tuesday night at 9 o'clock live. So if you want to do that, go to dhunplugged.com. Get there at about 8:45, 8:50 at night, tomorrow night Eastern time, and you can listen to us live and participate in the chat room where we take listener questions and let listeners and people chat with each other. Until next week, I really appreciate it. We'll get the link of this on the disciplinedinvestor.com this week. And of course, if you have any questions or if we stirred any interest in any of the things that we do and how we invest money in Investology, TDI, Managed Growth Strategy, or our global allocations, please give us a shout. Thank you so much, and I'll see you again next week.